Creative accounting consists of accounting practices that follow required laws and regulations but deviate from what those standards intend to accomplish. Creative accounting capitalizes on loopholes in the accounting standards to falsely portray a better image of the company. Although creative accounting practices are legal, the loopholes they exploit are often reformed to prevent such behaviors. The practice of recognizing revenue in a way that makes a company look better than it is while still conforming to the gap. Creative accounting seeks to inflate stock prices, for example, by selling assets at the end of a year to create a profit that offsets a loss. One could argue that creative accounting hides a company's true financial state, but unlike aggressive accounting, creative accounting is generally legal.
Regulators are trying to guard the qualitative characteristic of financial reporting, one of them being faithful representation. It is one of the important elements to reflect the accurate condition of a company. Regulators make attempts to protect the interests of users of financial statements. The users often make decisions based off financial information provided in the statements. For example, lenders will evaluate financial statements to decide whether they should borrow money or not. Finally, regulators are trying to close the loopholes which managers can abuse to give them a good financial image.
Since creative accounting can manipulate people's view on a firm's asset, it can make people think that based on the numbers shown in the accounts, that the firm is having a huge profit for the year, but in reality, it was a loss. By playing around the numbers within the gap and the rules of conceptual and regulatory framework, account preparer can give a biased impression of the company's performance. And to prevent creative accounting, regulators have been implementing laws and regulations to try to fill in the loophole in the framework, which gave opportunities to preparers to alter accounts unfavorable for the firm. Another way to prevent creative accounting is by taking ethics courses each year. As employees are usually working with the same mindset of the firm, business owners, executives, and managers' decisions affect a company's ethical behavior the most. Therefore, having an ethical atmosphere by taking ethics courses will help preventing accountants performing creative accounting.
Let's look at the strengths of the attempt made by regulators to prevent creative accounting. First, preventing creative accounting is an efficient and effective way to make information disclosure be open and timely to the public, enable people to understand the company's any important investment behaviors and business activities, so the receivers can evaluate profit and loss of companies to reduce future economic losses. Second, strictly preventing creative accounting by regulators can regulate accounting practices of companies. Strong and enforceable penalties on companies that apply creative accounting can help accounting turn to objective, scientific, and fair. Third, it can improve the existing accounting system and develop accountants' self-discipline. The accounting data presented should reflect the company's real and fair business conditions. This is accountants' professional and ethical duties, improving the quality of information disclosure and reducing the level of negative creative accounting depend on highly self-discipline of accountants.
However, there may be limitations on preventing creative accounting. Following are two main reasons. Firstly, different objectives by directors and accounting regulations. The main objective of directors is to attract investors and to boost share price, while accounting regulations aims to maximize benefit of outsiders, such as shareholders, customers, or government by increasing the transparency of the company. For instance, creative accounting may help to maintain or boost the share price both by reducing the apparent level of borrowing, so making the company appear subject to less risk by creating the appearance of a good profit trend. This helps the company to raise capital from new share issues, offer their own shares in takeover bids, and resist takeover by other companies. Secondly, creative accounting is not a fraud. Therefore, directors with non-professional attitude may continue creative accounting, neglect the implementation of rules and regulations. Creative accounting is not a fraud, but it takes the benefit of loopholes in the accounting standard and regulations. It cannot be said fraud because it works within the framework of law. It takes advantage of multiple options available in accounting. For example, whether to use LIFO or FIFO method for valuation of inventory. Managers use that method, which increase their benefit in that year and show higher profit.
To summarize, we discussed about the definition of creative accounting, which is accounting practice that follow required laws and regulations, but deviate from what those standards intended to accomplish. We also mentioned about the ways for regulators to prevent creative accounting, which are implementing laws and regulations to try and fill in the loopholes in the framework, and taking ethics courses each year for employees. And we also discussed about the strengths of preventing creative accounting, which are make information disclosure be open and timely to the public, and help regulate accounting practice of companies, and also improve the existing accounting system and develop accountants' self-discipline. And also we have mentioned the limitations on preventing creative accounting, which are different objectives by director and accounting regulations. And also creative accounting is not a fraud, therefore directors with non-professional attitude may continue creative accounting, neglects the implementation of rules and regulations.